What's up, everyone? It's Scotty with MoneyVest. So today we are going to be talking about Apple stock. This is going to be a full comprehensive analysis on Apple because they are going to be reporting their earnings next week. In other words, in the upcoming week. And this is going to be for the fourth quarter fiscal year 2023. They're finally going to be done and they're going to be reporting for the months ending in September. And October is basically when their new fiscal year begins, right? So October, November, December is Q1 of any fiscal year for Apple. So I'm going to do a complete analysis, like I said, fundamental analysis. We're going to break down every single thing you need to know about the business going into this earnings. And I'll also share my thoughts about the company because as we know that Apple is trading at somewhat higher multiples compared to historical levels. So all of that is going to be covered. As always, if you enjoy this video, find it helpful, all I'm asking in return is that you drop a like and of course subscribe to the channel if you're just joining us for the first time. I would really appreciate that. And the link to our Discord and Patreon is going to be down below. 16% annual discount that's available till the end of this month. And I also want to mention the October Halloween sale is going on right now for all the courses. So all educational courses, 50 to 60% off. Link's going to be down below. Coupon code Halloween, which is only valid for 2 more days. After October 31st midnight, that coupon code does expire. So link's going to be down below. You get lifetime access to all the educational material. So this right here is going to be the spreadsheet for Apple, as we already know. And this is, again, going back as far as 2009. So for as long as we can go back and find the data. And what I've done here is just to give you a little bit of a breakdown. I have broken this down into 4 CAGRs, right? CAGRs meaning compounded annual growth rates, 14-year. So basically from 2023 all the way through 2009. 10-year and then 5-year. And the reason why I've broken it down is because I want to show you that as numbers get bigger and bigger, the growth is slowing down, right? And because the slowdown in growth, that will affect the company's multiples and potential for future growth, right? And that's exactly what we're here to analyze. Just because a company has grown and done really well does not mean that's going to continue, right? It's really important for us to understand that. And just because the company has grown really well in the past doesn't mean that's going to continue. In other words, and also if the company is grown poorly or slowly in the past, does not mean that it's going to continue in the future, right? It could mean that, it could actually start to accelerate further. So obviously past performance is not any indication of future performance. And as Warren Buffett has said once, that today's investors do not benefit from yesterday's growth. I think that's a very, very true. But it gives us a little bit of an insight into what the future may look like for the company. That's exactly what we're here to discuss. I'm going to run through the entire valuation model to better understand what's the intrinsic value for Apple. Now, if you take a look at 2023, revenue expectations are just going to be just over $383 billion. So if you come over to Apple's earnings expectations, we're looking at just under $90 billion of revenue in this quarter that's coming up, and just under $1.40 per share in earnings per share for the business as well. It has been selling off, obviously. So from its recent highs, Apple is down close to 14%, and that's pretty much the all-time high for Apple at just under $200 per share. Now, iPhone revenue has pretty much made up over 54% of the company's overall revenue, as you can see over here. So pretty significant contribution from iPhones. That's the best-selling product for Apple. $207 billion in revenue expected in 2023. And the 14-year CAGR for revenue is 17%, and iPhones have grown substantially more at 22%. Now, if you take a look at 10-year and 5-year, it's obviously a little bit lower, right? In the last 5 years, in fact, the iPhone revenue has only grown by 4%. So that I think is going to be very, very important. Services have grown faster, 16%, and that makes sense because services, as the install base grows, as more and more people have iPhones, they're spending more on the App Store. They're spending more on the Apple services over the last 5 to 10 years, right? So 10 years also 17% is actually a pretty solid number for services growth. And I think this is where the margin expansion is coming from and multiple expansions coming from, because Apple's PE multiple has gone from an average 20 to now sitting at over 29, close to 30. And that's because if this services revenue is going to start to contribute more and more to the overall revenue pie, then that's going to lead to higher margins, because hardware and iPhone revenue, as we know, is a lower margin business compared to services, which is a higher margin business. Now, if you take a look at services contribution to the overall revenue, it's grown tremendously to now almost at 20%. It's been at 20% in the last 4 years, but it has also grown from the previous 4 to 6 years when it was at 11, 12, 14%. So Apple is, again, as the install base grows, is making more contribution for services as a percentage of overall revenues, right? So they've gone from 15, 20, 25 billion to now almost $80 billion in revenues coming from services. That's a pretty substantial number. Gross profits, 45% margin with an average of about 40%, 18% growth in the last 14 years, 10% and 11% in the last 10 and 5 years, respectively. Operating income, same story, 18% growth in the last 14 years, but 9 to 11% growth in the last 5 to 10 years. So you can see that as numbers get bigger and bigger, the growth does start to slow down, and the numbers are not as fantastic as 20-25% growth anymore, but they're closer to 10 to 12% for the company. Operating margin's been 29% on average. Earnings before taxes, again, same thing, 18% growth on a 14-year basis, 9 to 11% on a 5 and 10-year basis. And if you take a look at profitability, 19% growth in 14 years, right? That's a compounded annual growth rate. But if you take a look at some more recent metrics, right? So this is 10-10. Right, 10% growth on net income here for the business, 5-year and 10-year basis. Now, share buybacks have only accelerated further. As you can see that 14 years, only 3% share buyback per year, which has now accelerated to over 5%, right? So almost 5%, 4.89 and 4.61% respectively. And that's a pretty substantial amount of share buyback every single year the company is doing, right? That's pretty significant amount of, buying 5% of the shares outstanding every single year is a lot, right? And that's a little bit of financial engineering that Apple does to kind of boost its earnings per share, because you'll notice that even though the net income is only up 10%, right, in the last 5 and 10 years, look at their EPS. This is EPS growth, 15 to 16%, right? So this is going to be the earnings per share. And the reason why earnings per share growth is more than the net income growth is because of the buybacks, right? 5%. If there weren't any buybacks, then of course the net income growth would be very similar to that of earnings per share. If you take a look at EBITDA, again, 18% growth, 14-year basis, 10 to 5-year, it's going to be 9 to 10%. And this right here is going to be the cash, substantial amount of cash increasing every single year, 21, 22, 33% growth. And this is going to be free cash flow. Actually, this is the market cap. Excuse me. This is the market cap. This is the cash, 16 to 22% growth. Substantial amount of net debt. So we've never had any issues with Apple's balance sheet. So more cash than debt on the balance sheet. Current ratio is a little bit under 1, but again, it's Apple. So they've got lots of cash and marketable securities. And free cash flows have also grown by 20% on a 14-year basis, but more recently, again, you can see this growth rate kind of starting to moderate a little bit at 9 to 12%. And we've got the install base at a 33% growth, 14-year basis, and 16 to 10% growth on a 5 and 10-year basis, or 10 or 5-year basis, respectively, with a free cash flow margin of 26%. Now, that's pretty much the overview of the business. Very consistent numbers, very nice growth every single year, growing and moving in the right direction. And Apple is, as we know, is one of the best, most loved companies in the world, as I would say, and probably one of the most well-managed companies in the world as well. Now, if you take a look at the valuation, and you'll notice that, Apple has indeed traded at lower multiples. So, for example, the average of 14 years for Apple is around 4.61. But more recently, though, it's now started to accelerate a little bit over 7 to 8 times sales, and right now sitting at just over 7.4. Price to free cash flow, 17.7, a little bit under 18 has been the average. Now it's at 25. It has been a little bit more elevated over the last 5 years at over 22, 25, 30. So if you basically take the average of these numbers, it's most likely going to be 25 or higher for Apple over the last 5 years. So the valuation has certainly increased, right, compared to its 14-year average. Price to earnings also. Take a look at the last 5 years, 29, 28, 29, 23, 38, versus the average of 20. So, one could argue that Apple is, yes, 50% more expensive than its 14-year average price to earnings multiple. But then we also have to understand that last 5 years, the business has changed substantially in a way that contribution margin from Apple's core iPhone business has gone down, which is actually a good thing from a margin perspective, because services are making a bigger impact on the overall revenue, and you can see that in the gross margins, right? They've expanded substantially from 38% to 45%. So margins are getting bigger for Apple, even though the growth rate is slowing down, but the business is shifting from hardware to services, and as a result, you can see that margins have expanded, and again, 27 to 31% in operating margins. Net margins have gone from 21, 22% to now 25%. So profitability is actually growing for the company because of more margins coming from services, as services make up for slightly more of the revenue pie than compared to 5 years ago. So that's why I think the valuation multiple could be argued as both justified or could also be argued as being expensive. Really depends on, who you're talking to or who the analyst ends up being. I think it's justified, but not for the growth, but for the contribution margin that's coming from services. Enterprise value to EBITDA 14 has been the average right now, 21, and price to cash 13.5 has been the average at just a little bit under 16 is where we are. Now, what I'm going to do is I'm actually going to take a 5 or a 10-year CAGR for our analysis, okay? So when you take a look at earnings per share, or net income has grown by 10%, earnings per share have grown by 15 to 16%, and that's accounting for 5% share buyback, which we will also account for. And analysts are expecting the earnings per share to grow at 9% over the next 5 years. So from 2023, just over $6.07 to just under $10 per share. And that's going to be about a 9% growth for Apple over the long term, over the next 5 years. And free cash flows have also grown, as we mentioned earlier, a little bit over 12%. 12% on a 5-year basis, 9% on a 10-year basis. So when we run through analysis, I'm going to use a 9 to 10% growth rate for net income and about a 10 to 12% growth rate for free cash flows. So let's just plug in our Apple here. This is going to be for net income. So trailing 12-month net income, we're going to use this number, which is the net income here, 95,820, so 95,820. And I'm going to apply about a 10% growth rate for net income over the next 5 years. 12% discount rate, 10% margin of safety, and a minus 5% share buyback, which of course is substantial. Now, when it comes to the price earnings multiple, the average we know for Apple has been around 20, right? 20 has been the average price earnings multiple over the last 14 years. But because the company's services contribution is increasing, margins are going up, I think it can demand a higher multiple. I think it can go up to as much as 22, 24, even if you go 24. We're looking at $156 price. That means only 7% overvalued from where it currently is trading. But again, it depends on where your price earnings multiple ends up being, right? So if you come over to the sensitivity grid, you'll notice that we are right here in the middle at 156 or 169. That's depending on a 24 to 26 times price earnings multiple and about an 8 to 10% growth rate, which I think is quite reasonable. I think the growth rate is good, right? 8 to 10% is no doubt. I have no doubt in my mind, or I'm confident that, okay, Apple can grow at 8 to 10% over the next, 5 years. It's just the multiple, right? Will there actually be a multiple compression for Apple in the future? And if so, what is going to be the fair value? So even if I do come down to, let's say, the average, right? If you go with like 20 times price to earnings and about a 10% growth rate, right? So if you go across and you come down, we're looking at $130. $130 being the actual fair value. That's going to be this number over here that I've just highlighted, which is going to be the fair value or the intrinsic value for Apple, given a 10% growth rate and a 20 times PE multiple. So if we make that adjustment here, then we are looking at $130.29. That means 23% overvalue from where it's currently trading. So again, it's really dependent on you, right? I mean, you have to decide as an analyst what's appropriate for Apple. I would be more comfortable at $130 just knowing that, okay, there's a 10% margin of safety built in, there's a lower growth rate that I'm going with, and there's also appropriate price earnings multiple in case there's a compression down to the average for Apple. Now look, as consumer sentiment works and as stocks trade, they overshoot to the upside, they overshoot to the downside. So it's not unlikely for us to believe that at one point, maybe in the future, that Apple doesn't trade at 20, it trades at 18 or 16 or 14, because as we know with most companies, Meta, Tesla, Nvidia, PayPal, like a lot of these companies, they've overshot both on the upside and on the downside. So it doesn't necessarily mean that when stocks come down, they come down to the averages, they come far below the averages, and then they revert back to the mean, right? So most of the time, stocks are not trading at fair values. They're trading at either above their average or above their higher their fair value or lower than their fair value. Now, if you run through the discounted cash flow model, it's going to be a very similar analysis, but a little bit different. So what we're going to do is we're going to use the free cash flow number in this example. So let's just go over to the free cash flow. That's going to be close to 111,442. So 111,442. And we're going to go ahead and put a 12% growth rate for the free cash flow. And we're also going to apply, just got to switch this to Apple, 12% discount rate, terminal growth rate, I think 3% is good, and then a minus 5% share dilution. We end up with about $136 in the intrinsic value, which again is going to be a 19% overvaluation at the moment for Apple, which is going to be very similar, almost similar. So we got $130 using our discounted earnings multiple model, which is again $130, and the discounted cash flow puts us as $136. So close to 130, 135 is where I could see myself kind of nibbling into Apple a little bit. Of course, the lower the better, because we want to look for this stock at being undervalued. So every stock that I buy, I want to buy it at undervalued levels and not really at intrinsic value. But $155 is going to be that support level to watch going into these earnings, with 175 resistance sitting for Apple right over here. And as I just showed you guys, my fair values in the 130 to 135 for Apple. And below that, of course, 122 is going to be the most ideal price, in my opinion, for me, for Apple. So this right here is going to be that level for Apple that I would be potentially very aggressive in buying at these prices of 125 or lower. So hope you guys enjoyed this video and a quick an overview on Apple stock. Let me know your thoughts down in the comment section below, and what do you think about this company. And as always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.